The next panel is up. It would be moderated by Mock Fitzpatrick of Glide Capital. It's on private credit. The title of it is Private Debt, Direct Lending, and Private Credit Investor Considerations for 2020. Mock Fitzpatrick, are you on the line?
I am. Can you hear me okay?
Yes, it's perfect.
Great. Perfect. Well, thanks, Mike. And to start, I want to congratulate Flya for navigating, which is a very challenging year for everybody. That in these times of change, there's always turmoil, and you define yourself by being able to adjust to it. So we're going to talk a little bit about private credit today, and what we're doing within the space, and we encourage everybody to ask a lot of questions through the tools here, and we'll keep it flexible so that you can do that. So maybe to start, private credit's a very interesting asset class that our firm has been focusing on it for 5 years, speaking with over 600 managers in the space, because we know that it's a very attractive asset class, that it has the potential for higher yield in the fixed income space. It has a potential for lower volatility as well. And the higher yield is coming from the fact that these private markets are less developed, and the borrowers have less access to capital than those groups in the public markets. And the banks have exited many types of lending. So there are a lot of fast growing companies and real estate projects and other borrowers that are looking for capital and willing to pay higher rates and give very strong collateral. At the same time, the volatility can be much lower because you're in the private markets instead of the public markets. Of course, the offset to that is there's less liquidity. However, that less liquidity means that you can have much lower volatility because these securities aren't being traded on a regular basis or on a second by second basis. So our goal today is to try and help navigate investors through the private credit markets, and we've got some interesting panelists today. So let's maybe start with you, Rob, and if you could give us a quick intro of your firm and what area you focus on within private credit.
So we're Boomerang Capital. We do hard money lending. That's going to be single family residential, hard money lending, traditional kind of fix and flip type things. We focus in Arizona, Colorado, and Texas, so the western states, but we do have some exposure nationally. We're in about 31 states.
Perfect. Great. Thanks. Jeff, do you want to start for Sheridan?
Sure. Thank you, Mark. Sheridan has been in business for 19 years. We've done over 140 transactions, and we focus on strictly specialty finance, and we do it through 4 channels. One is providing senior secured financing to point of origination specialty finance companies, could be consumer, commercial, or esoteric in nature. Secondly, we finance distressed debt buyers in the specialty finance space. Could be small commercial mortgage, resi mortgage, equipment lease, consumer, litigation finance, bankruptcy, small business. The third is we find novel origination businesses to grow that might not necessarily be securitizable in large quantities, but you can buy enough assets and make sense of it and do it at a good attachment point. And the fourth bucket is finding orphan assets in the specialty finance world, either performing or non-performing. And so, having a distressed endpoint of origination background, we think gives us a novel perspective on how to buy and finance assets and then how to own them and manage them.
Perfect. Thanks, Jeff. And Dimitri, can you give us an intro on Horton Point?
Sure, Mark. Thanks. Hi, everyone. So Horton Point, we are a family office-based alternative investment solutions firm. Our primary business is providing customized solutions to both investors in private funds, specifically hedge funds, as well as fund managers, in terms of essentially closing the gap that many investors might have or some inefficiencies which might preclude investors from making investments in the funds that they would otherwise like, but cannot until a solution exists to close that gap. So some of these solutions have to do with tax inefficiency for taxable investors. Some have to do with certain risk inefficiencies that fund managers deliver to investors that they may not accept or like. I am on this panel speaking specifically about private lending solution that we have developed and are basically launching very, very shortly, that essentially provides capital efficiency to investors looking to invest in high quality hedge funds, but do not have access to either leverage or basically do not have the ability to borrow against their position in those funds. So essentially $1 of an investment gets them $1 worth of a return, and that's not really efficient. This solution is going to enable investors to make their investments far more capital efficient, and that's pretty much what we are here to talk about.
Perfect. Thanks, Dimitri. And just a quick overview on Glide Capital. We started the business 5 years ago for the purpose of building turnkey solutions to allow wealth management firms and institutions to build portfolios within niche strategies within private credit. That we've spoken to over 600 managers in the space. We focused on short-term, well-collateralized managers. We've got 23 funds that are approved, and then we work with wealth managers to build them a portfolio that is best suited for their firm and their clients, so that each wealth management firm has their own portfolio, and we take care of everything from the operations legal standpoint as well. So, quick state of the union of the private credit industry. That 2020 was obviously a very interesting year. It's a great test for the private credit industry because a lot of it has, the industry has had a lot of growth over the last 10 years, and many of the strategies have come out of the last crisis. And so this is the first real test where there's been many businesses that have been created or many lenders outside of the banks that have been created in the private markets. This is the first major challenge. And so it's interesting to hear from each of the panelists what they're seeing. Maybe Jeff, if you want to start us off here and let us know, how your strategy is changed in 2020 and what you're seeing as a result of the pandemic.
Jeff, you need to unmute yourself. We cannot.
Yes, no, I have myself unmuted. Thank you, Michael. We're seeing, like in any cycle, we're seeing opportunities, and private debt has such a large connotation to it as far as what are we talking about. I think people most of the time think about it as sponsored middle market lending, but there's a heck of a lot more verticals and exposure one can get. And I think depending on what types of exposures you are involved in, 2020 has been a difficult year. And in some regards, it's been a attractive opportunity year. What we try to do at Sheridan is find opportunity sets that allow us to take advantage of illiquidity premiums. And so, as an example, we're involved in litigation finance. We're involved in small business lending. But as an example, our small business lender that we finance didn't have hospitality, didn't have transportation, didn't have retail exposure, was geographically diverse, didn't have New York-centric risk on his book. So he's fared fine through 2020. So charge-off consumer debt, interesting space to play, depending on how you price it and how much room for variance you allow yourself. But we've, found opportunity there. We found opportunity in the hard money space by providing liquidity to lenders that are hung with assets. We've we've got opportunity in the distressed equipment lease space. So because we have the ability to finance, acquire, and liquidate performing and non-performing assets, and we do it across some diverse verticals in the specialty finance space, whether it's Sheridan or your own portfolio, I think you just have to be aware of the surroundings from a macro perspective, give yourself room for error, and get paid an illiquidity premium. So we are finding opportunities, and we believe the opportunity set will become more robust in the first quarter of next year when the banks and some of the financial institutions are under a little more pressure to divest assets.
And Jeff, you've got an interesting perspective in that you look at many different types of private credit strategies. And so which ones do you see, how's the performance been overall during this challenging time? Is there certain areas that have lagged, others performing well? What have you seen overall?
Well, I think one of the interesting observations is originally the pandemic occurred in the first 2 quarters, which is tax season, and there was a lot of fiscal and Fed support. So there was a lot of opportunity early on QSIPs, which we don't typically play in, and then the Fed came in and collapsed spreads there. In the non-QSIP private debt area, depending on size and scope and geographics and what your play was, you know, we saw opportunities in the small business lending space because, you know, we were able to mitigate the concentration issues you had if you were in bad COVID hit jurisdictions and in the wrong industries. And like I said, in charge off consumer debt, I think there's opportunity because you're going to price that over a 3-year curve or a 5-year or a 2-year curve. There's, you know, been plenty of opportunity there to play in that space. In the litigation finance space, which is non-correlated to that space, has been affected a little bit, again, if you had the wrong geographic composition, because some of the court systems weren't able to support some of the opportunities. In mortgage-related opportunities or even bankruptcies and consumers, some of the forbearance and mitigation tactics the regulators and government put in place, that sort of affected some of these asset groups. So I think in all those spaces, there are attractive opportunities. You just have to know what geographic, what specific area, what area of the economic strata. You know, there's all these different things that come into the equation if you're an opportunistic and not just an asset gatherer, but an opportunistic player. There's been opportunity, and you just have to be very idiosyncratic with the way you look at it.
Great, thanks. And Rob, maybe you can give us a state of the union in the hard money lending strategy and the real estate strategy. I know that you focus on certain areas like Arizona and Texas and I think Colorado. Can you tell us why those areas and really what's happening in the private lending in real estate strategy in 2020?
Yeah, so I think Brian Bailey this morning from the Atlanta Fed covered why the West for us, which is, you know, you've got this big rebalancing, you've got this movement out of the coastal, the more expensive coastal, and you've got an ability to support much better the economies and stuff. So, you know, he really showed why we prefer the West. You know, as far as what's been going on in our space, it's been really, really fascinating. When COVID hit and those sorts of things, we were very scared for really a very short period of time. I mean, the slowdown in the single family residential lasted all of about 2 weeks. And then everybody wanted to get back in, everybody wanted to bottom fish. we were thinking that the prices were going to be at, 70 cents on the dollar, and that those just didn't happen. And then it was 80 cents. And then we quickly got back to, even within those really scary periods, we were looking at prices 94, 95 cents. And now, of course, those prices are 112, and those sorts of prices relative to where it was before. The interesting thing that happened, we had a number of our competitors disappear. And I think it sounds like, if I read between the lines of what Jim just said, they financed some of those, some of the guys that got in trouble. What happened is we had 2 or 3 very large players that were really, they were selling into CMBS markets, those sorts of markets. Those markets dried up. And so that whole infrastructure, that whole broker chain broke. And so there were guys left with pieces and parts. The other thing that happened, which was welcome, was standards got tightened. We had, going before COVID happened, we had people that were lending 100%, financing those sorts of things. Remember, these are business purpose loans. These are not resi loans where you've got somebody in the house. These are houses that are going to be fix and flipped. So they need to go through a value add process. But people were doing 100% financing, competitors of ours, and that was not good. And those people got washed out. So standards are, they've loosened a little bit, but standards are still relatively where they need to be. So a couple things that have developed that are not welcome in ours. Of course, we really don't still know what's going to happen with the employment and whether, when the stimulus comes out, what's going to happen. Another thing that was not welcome in ours, and you can imagine this, the courts slowing down. So we have about a 1% default rate. We'll do 1,000 or so loans. So we'll have 10 go belly up, or have to go through significant restructuring and or foreclosure on our part. So, and those slow down and they just take a lot of energy. So that was not welcome. You all know that already. So 2 things that were unexpected and negative. One is it's hard to get houses. So there's a lot of demand still, but people are still not listing houses. So one of the big reasons that prices have gone up is people just aren't selling their houses. They're not rotating through the houses like they usually do. So there's demand to buy, but there's no supply of sellers. So that's been difficult. And then costs have unexpectedly really rocketed for our underlying borrowers. For example, if you look at lumber prices in May, and they had gone up just a little bit in there. Lumber prices using the futures in May were $300. And by August, those had grown to $800. It is now, since it's about 520 or so, 22 today. So when our borrowers are looking at profitability of projects, that profitability has been hit by, they had to pay a little extra for the house, and then the rehab costs have been higher. And it's hard for them to find subs. It's hard for them to find faucets. It's hard for them to find cabinets and those sorts of things. So that has been something that we have been talking about with our borrowers. Everybody's fine, but it's hard when you're talking to a borrower and a borrower thinks that they're going to make $40,000 or $50,000 on their project, and that gets eaten into, and now it's only 30. They're still positive, but it's less than it was. So that's a little bit of an overview. I hear you pretty good, Mark.
Yeah, no, great. And Dimitri, that obviously you've got an interesting perspective as well as you determine what kind of funds to lend into in this industry, and that we know that you like liquidity, which allows you to leverage certain hedge funds. But what about the private debt sector? What are you seeing within that sector, and how are you looking at it in this year of the pandemic?
Yeah, so it's interesting. We have a slightly different perspective here because you're right. We look at our collateral, basically, which are hedge funds primarily, from the perspective of risk and liquidity and all sorts of things. But our objective is to provide as low a cost of funding to investors. So to borrowers who are investors in those funds. So our clients ultimately are these borrowers, and we really, our objective is not to maximize the borrow rate. Our objective is to deliver to as many borrowers this solution. So what we are seeing is actually, it comes from the behavior of borrowers themselves, specifically hedge fund investors. When we started working on this project early this year, probably 80% of inquiries coming into us came from investors who wanted to raise cash without having to basically exit from their current hedge fund investments. As we know, every time there is a crisis, investors who need to raise cash run to their most liquid funds and if effectively redeem from those funds. And of course, this happens to be usually the worst possible timing to do that. So about 80%, as I said, of inquiries early this year came from people who wanted to preserve their fund investments, yet needed cash for whatever reason that they needed cash for. It wasn't so much to lever up their current positions. It's more take some cash off the table. And once we've solved that, it was very interesting to observe that this ratio of people who are looking to borrow basically cash versus people who are looking to borrow to enhance their leverage or essentially get leverage where there was no leverage before has dramatically switched. So now it's probably 80-20 the other way. So 80% of borrowers that are coming into us are looking to essentially increase the return, increase the leverage. So use that line that we're giving them to increase their exposure to hedge funds. Whether this is going to continue, of course, we don't know, but that's been a very marked change in investor behavior, in borrower behavior rather, during this year.
And can you talk a little bit about what is your typical borrower look like? What kind of size of facility are you providing, and what kind of advance rate are you looking for in the funds that you're funding against?
Sure. So this market, the market of financing private funds, is very well established for very large institutions. If you're a large institutional portfolio, you will have no problem financing any of your portfolio positions. There is a very large slice of this ecosystem, which is represented by single family offices, by high net worth individuals, by advisors like independent wealth advisory space, by smaller institutions. So essentially investors who have, call it less than $50 million invested in a single hedge fund, or maybe less than 100 across a small portfolio of hedge funds. So that clearly is a very large universe, and it's completely unbanked when it comes to having access to financing, these particular investments. So this is our audience. Again, we've been inundated with incoming inquiries because people who know us understand that solutions like this are very difficult to structure, and we are probably one of the very few teams out there that is able to do it. So we're basically targeting investors like this. In terms of, you asked about the kind of general terms of these loans. So we are pretty conservative lenders. We lend between 25 and 50% LTV against the fund value or fund NAV. We charge, or we try to minimize the borrow rate as much as we can. It obviously depends on the underlying fund and its risk, but generally the range is between 3 and 3.5% per annum all in. So clearly this is a very attractive value proposition for any investor whose funds can generate higher returns than 3 to 3.5%, and hopefully most of them do. Therefore, an investor gets into a positive carry position, and that becomes a value additive proposition to that potential borrower.
Great. We're going to talk a little bit about liquidity in the private credit world. As Jeff mentioned, there's a lot of people, when they think of private credit, they think of middle market lending. And there's a lot of funds out there that are 7 to 10 years, which are very interesting for institutions and other groups, but not everyone can take that type of liquidity. There's also a lot of these niche strategies that are more focused on 1, 2, 3 year type liquidity. There are open-ended structures and there's closed-ended structures, and it's liquidity is something that we wanted to focus on a lot as a firm, and how well these managers are doing in this type of environment and how they're maintaining liquidity, because all of a sudden cash became very, very important in this time. So Jeff, maybe you can talk about what kind of structure that you have within this space and why and how you look at liquidity.
Well, being in business 19 years and going through the 08, 09 downturn, one of the things we were really proud of is we paid very close attention to liquidity. So when 08 and 09 came, we had a senior leverage facility, and we were the first ones to pay the principal and interest back. And we saw the storm coming, but we weren't in the business of shorting CUSIPs. So we were in a good position to make sure our senior lender got paid back. In the world we live in today, that's why we typically have not done a hedge fund structure where the assets don't match the liquidity. And so the nature of the way we fund transactions is on a transaction by transaction basis or in a lockup vehicle, meaning we make sure that the liquidity in the vehicle matches the liquidity of the underlying assets, so that you're not caught in a situation where you're forced to liquidate. So I think like anything else, you can do an open-ended structure, which there's some asset classes in the private debt market that we will, but if we do that, we're going to be very mindful of making sure that the liquidity terms and the transparency is 1,000% clear. Because investors, everybody gets amnesia when we go through a rough patch and they're surprised that they signed up for something that doesn't allow them to get their assets back, where somebody puts a gate up or whatever tool they use. We think the best answer is, one, being very cognizant of matching your assets off and your liabilities off, and two, most importantly, being very transparent in your marketing and your subscription documents to make sure that the investor can't not walk away knowing that, hey, if there's a problem, here are what the liquidity terms are, here are what the assets are, and we know that we might not be able to get our money back until the assets can be liquidated in an orderly basis. And so I think that is just absolutely paramount. Transparency and openness with the investor, and matching off the assets to the underlying assets to your vehicle liquidity.
Absolutely. And we're in the private sector here, so it's not like we sell these loans. There are secondary, tertiary markets in certain of these strategies, but not every one. And most managers agree that they don't want to be forced to sell loans at a discount in order to raise capital. Rob,
can I add one thing to that, Mark?
Of course.
I think the other thing people can lull themselves into comfort is that you might have a collateralized loan or opportunity, but what's really the underlying liquidity of the underlying asset? And I think if you're good at understanding and executing as a private debt steward of someone's capital, is you understand the underlying liquidity of the underlying collateral, and you have a plan in place and understand timeline and what you need to do to create liquidity in that asset. But I think that's one of the big things of, as an investor, if I was investing with anybody, what kind of plan do you have? What kind of experience do you have at actually working out assets that don't perform as planned. So I didn't mean to interrupt, Mark, but I think that's really very critical for people to pay attention to.
Absolutely, and good point. And that's something that we look at as well. And again, we're looking at the whole industry. We do a lot of real estate lending strategies. We do life settlements. We do business lending and other strategies. So it's important to help our wealth managers navigate liquidity and always be diversified and always make sure that we've got kind of the right match between what it is that their clients need from a liquidity perspective and the liquidities of the underlying strategies, and making sure that in a time of crisis that there's not a run on the fund if it's an open-ended structure. Rob, maybe you can talk about how you operate, what kind of structure you operate in, and how investors have been patient or not patient during this time.
Yeah, so we do REIT. We're in a REIT structure. It's a fund, and then the fund is a REIT. We're owned by the LPs. Boomerang Finance is technically the manager, not the owner. The owner, of course, is the LPs. We, you can look at our return stream. We're the orange there. So we're not volatile. And to that end, in the first big downturn, we had a lot of more investor interest because we were non-volatile. And then in the upturn, people, definitely some people of our investors were happy to discuss how they were doing in the stock market. In the recovery, they weren't so happy to talk about it in the other part. But really ours, I don't know. I put it up relative to the S&P. I don't know what people should be comparing us to. When we talk to our investors generally are just, they like boring, and we provide boring. We don't have a marketing department, so nobody kicks me in the shins when I say boring. But that's really what our investors are looking for. As far as us relative to, some of our competitors, and you just talked a little bit about some of those, we have a lot of respect for a number of our, not all, but a number of our other competitors that do what we do. We exchange information with them. There are some really high quality operators in the hard money lending space. To give you an idea of how big this space is, about 15% of all, roughly, it's a little less, but about 15% of all single family residential transactions in the US actually go to an investor. And of those investors, I would say, probably, maybe a third or so are using hard money loans in one way or another. So, that's 5% of all transactions. That's quite a bit. And there's some other people that do it and that do it well.
Great. And we're going to get to, I'm going to ask you a question in a second on that straight line up, because we see a lot of that in the private credit industry. But first over to Dimitri and maybe talking a little bit about private credit and providing leverage within this strategy. How do you look at it between these open-ended vehicles and these closed-ended vehicles? Because we know that the closed-ended vehicles are a perfect match for the liquidity of the underlying assets, because you raise the funds and investors are locked up until the loans are matured. And from that perspective, you have a perfect match. But there are a lot of open-ended structures that provide better liquidity as long as they have the liquidity from the underlying assets. When you look at this industry, what kind of funds will you lend on within the private credit sector?
So that's a great question, because the industry is changing so fast that our target is continuously expanding. So our obvious target number one is any open-ended fund with relatively high level of liquidity. We're not looking for daily or weekly, but generally quarterly to semi-annual liquidity is okay for us, open-ended funds, right? Our fund that we raised, and it's about to close, it's a $300 million vehicle with very patient institutional capital. So this is a multi-year kind of time horizon for the source of capital, and therefore we're happy to lend money out even to investors in open-ended vehicles for a multi-year time kind of horizon. It could be a term loan that's maybe 12 months term that's renewed every quarter or every 6 months. So we're happy to have these loans out for many years. However, interestingly enough, the private equity space and private lending space, so these are closed-end funds, which typically would not generate any interest from a lender's perspective, because if obviously you care about liquidity in these cases only in cases of default, right? If your underlying asset, meaning the fund, breaks the covenants or defaults in some way, you have to be able to liquidate that asset relatively quickly. And while it's possible with open-ended funds, what do you do with closed-ended funds? So initially, we focused exclusively on a certain slice of the hedge fund space, which is quite large, frankly. It's hundreds of billions of dollars in total assets, but still, it's just that slice. With the advent and really incredibly fast development in the secondary market space, we are now looking very closely to private equity funds and basically pretty much any closed-end fund from that perspective. Because if we can get liquidity in the secondary market, and to be clear, we're not looking for liquidity on a day-to-day basis. It's only in cases that something really bad happens and we need to liquidate that asset. So literally in front of our eyes over the past couple of years, the secondary, that secondary market actually developed from almost nothing to an incredibly deep and wide space. So now we're looking selectively at these closed-end funds as well as potential collateral. From that perspective, are we able to find enough, liquidity in a secondary market so we can exit in those extreme circumstances? I hope that answers your question.
Absolutely. And one of the things that we always look at when we're looking at funds is whether or not there is leverage within the strategy. And typically we don't invest in too many strategies that have leverage, because we want to make sure that that they're not forced to liquidate any sort of loans out there. And that's a big point when there's a crisis, is that sometimes with the banks that there's a lot of money and they provide facilities, but then they want to pull it at the worst possible time. So how do you, when you're talking to your clients that are borrowing, how do you convince them that you're going to be there in the challenging times and that you're not going to pull the facilities at the worst time?
Right. So it all goes to really deep dive due diligence by subject matter experts. And our team has probably on average 20 to 30 years experience each in looking at hedge funds, analyzing funds and portfolios of all kinds. Somebody, basically a match of assets and liabilities was mentioned a couple of times. So basically, liquidity match between the underlying portfolio and the liquidity of the fund itself. And that's of huge importance to us. We look at the underlying portfolio, not so much from the leverage perspective, but from a kind of distress perspective. What happens if the market really dislocates? And what happens to your assets? How quickly are you going to be able to divest or exit within your portfolio? That takes a bulk of our due diligence. We look deep inside each fund to understand exactly what their liquidity profile might be. And keep in mind, leverage on its own is not your enemy, because we're dealing with a lot of market neutral equity long short funds with leverage 5x, longs plus shorts, but their net exposure is very little. Similarly, a lot of global macro funds might be levered 10 to 20 times. Again, liquidity for them is not a concern. Our concern is how much can they lose in any kind of investment period, whether it's monthly or quarterly, and how fast can they get out in cases of a market dislocation. So again, to answer your question, we're laser focused on the matching of the underlying funds portfolio and that funds, liquidity terms.
Great. And we're going to spend the next 10 minutes talking about risks and opportunities that we see coming down the pipeline in 2021, and get to a lot of these questions. So there's been a lot of questions that we're trying to answer, and we're going to spend the last 10 minutes talking about some of them that we're receiving. So please continue to send in those questions. But first, maybe Rob, if we can go back to your slide, you can see that your performance is like a straight line up. And this is very, very common in the private credit industry. And there's a lot of people that say, how can you do this? Why is the line straight up like this? And we see a lot of fact sheets and performance in this space. And it's important for us to distinguish the risks within the portfolios and who's using leverage, who's got collateral, who knows how to operate the collateral, how are the portfolios being valued. The many questions that goes beneath the understanding of this consistent performance. So first and foremost, again, this is in the private sector, and these funds are typically reporting on a monthly basis, and they're basically accruing interest. And as long as they have strong collateral to offset it, as long as there's no reason to write down a loan, then you see this type of consistent performance. But maybe you can explain, Rob, from your perspective, how you've been able to continue this type of performance. And for somebody that's looking at a hard money lender or commercial real estate strategy, what do you look for when it comes to risks and understanding this performance, and will it be able to continue?
Yeah, so Mark, you're crushing me, because I thought I was special, and now you tell me I'm just one of many. So that really hurt. But I'll try to wipe away the tears and answer that. And really, we can go on. I could go on. So anybody who wants to go on more about this, I'm going to hit it really briefly. But feel free to call me. We can go through it. So a couple different things. Why does it go like this? Because really, our business is relatively boring right until it's not. And so a lot of times when you're seeing these lines, and some of our competitors representing them and those sorts of things, this is what it looks like right until it doesn't. And so let me go into a couple reasons how it goes kind of south, and how this all of a sudden, my experience with, like I said, some of our other funds, some of our other competitors, we have a deep appreciation for, respect for, those sorts of things. And really how these fall apart is these lines are generally, there's not a lot of volatility until all of a sudden, oh shoot, we forgot to tell you that we had 10% NPLs. That is the order of magnitude that when we talk to our banks and those sorts of things, that's right when these fall apart. And a number of our, so I referenced a couple of the big guys, that's where they were. And the banks pull their lines. Our NPLs, we're right around, we're a little bit, depending on how you count it, but we're right, call it 1%. So a couple things when you're looking at these guys, kind of due diligence, and you can ask us these questions too. One of the things, what do you do with your origination fees? So a number of our competitors that we do not have respect for take their origination fees, and that goes to the manager, and then the loan that they originate goes into the investors. Well, the problem with that is that then the manager is incented to create new loans and just stuff the portfolio with whatever they can get in there. As long, hey, I got my money, I got my origination fee, I'm done, and I'm just stuffing you. And you saw that with North Rock and Northern Rock and a lot of those guys that blew up in the other times. Can they take back and operate? And what is their experience with taking back and operating? We can go through, our portfolio. We've got 7 or 8 on the books right now that we're working through. And how do they take those back? So one of the little games that people play is we don't have any NPLs, we don't have any REO, we don't have any of those, because what they do is they put that over into an SPV. And what is the remoteness of that SPV? What is the P&L of that SPV? How do they treat LPs that are in the current fund? How do they treat LPs? There's a transfer price there. What is the transfer price? How does the transfer price work? All of those sorts of things. One of the larger competitors just took their entire portfolio that would no longer be serviced, no longer be funded really by Wall Street, and they created a distressed fund. So now they've got this great distressed fund. Well, the reason that they have a distressed fund is because they blew that up. So there's a lot of games that get played. And then you also want to look at other lines of business. Are those other lines of business complementary? How long have they? So a lot of our competitors, they think cannabis loans are a great idea. That may or may not be, but it's a different type of business. So you want to look through the portfolio. We do it a little different. It's not just origination. It's also the underwriting process, the positioning. We think of it as a portfolio, and then the servicing, we maintain and keep our own servicing. So I don't want to monopolize it, but if anybody wants to talk about that stuff, there's a lot more.
Yeah, many questions that we asked during our due diligence as well. And so for the next maybe 7 or 8 minutes, I just want to ask each one of the panelists maybe a 2 or 3 minute answer to say where are the risks and where are the opportunities going into 2021, because we know that when the pandemic first hit in around February and March, that we spent a lot of time talking to the managers and seeing how their investors are reacting and how their loans are performing. And some were performing very well, and others, they knew there was going to be challenges. And there's a lot of, but their collateral was always very good. And so they knew that they were in a very good position to be able to continue to have strong performance. And it was more the borrower that was the one that had the majority of the risk. And they were looking to work out these loans and help these borrowers at the same time representing their investors, that they needed to make sure that they're able to continue to deliver the strong and consistent returns, but they knew that they were in the strong position if they had good collateral and asset management capabilities. So Jeff, maybe to start, you can spend a couple minutes talking about where you see the risks in the many assets that you're focused on, and the opportunities. What are you most excited about, and what are you most concerned about?
I think that as we have a dynamic business, as everyone else who's listening to the panel, the intermediate, short-term, and long-term risks are a little bit different. In the interim, we have an election. What post-election? What is the uncertainty going to be with political response? If are the Democrats or the Republicans going to control split House and Senate and the White House? So depending on what happens there, will have sort of a domino effect on regulatory issues in different businesses, liquidity, focus of stimulus, all those geopolitical issues that we're going to have to sort of be mindful of. And then the traditional risks that you find in each one of the spaces that are structural, that as the cycle matures, how much liquidity is still in the space. When you're looking at your transactions, how much is naturally liquidated, how much is refinanced or somehow bailed out of a bad situation. And thirdly, just from a long-term perspective, but most of our assets are short, and we do short duration opportunities. If you're looking at longer duration opportunities, is what are the ramifications of the deficit? What are the ramifications of tribal politics? What are the ramifications of new regulatory and new policy? So I think short, intermediate, and long term, there are different types of risks. The opportunities in our space because we're an opportunistic player, we see a lot of distressed opportunities coming in the first and second quarter of 21. And so we're positioning our platforms to be able to take advantage of opportunities that are going to present themselves because of some of these intermediate and short-term liquidity and regulatory changes. So we think litigation finance, we think small business, we think consumer, we think equipment, we think resi and small commercial, we think small commercial.
Okay, I think Jeff, you went on mute there, so appreciate that. One thing that's we really learned that we already knew in 2020 is that the public markets react a lot quicker than they do in the private markets, and that the markets can go down, 20% in a matter of days. As there's a lot of computer trading, everyone's got liquidity. When there's uncertainty out there in the markets, people are reacting. And we also have, computer traders and algorithms that are a big part of the markets today. Whereas in the private sector, there's almost this forced patience, and it takes longer for these things to play out. And again, you're not dealing with securities that are traded on a second by second basis. And what we're focused on are loans with good collateral. So as long as that collateral is not going down 40 or 50% within months, which we haven't seen at all, then we should still be able to give this positive performance. So maybe Dimitri, if you could say how you look at kind of private credit from that lens.
Can I just give one?
Oh, sorry, you're back, Jeff. Welcome back.
One more comment is, I think it's really very simple. It's understand the collateral that's securing your loan and what is the true liquidity in that collateral in robust times and in distressed times, and match off your liquidity with your assets, and make sure you look at and see the track record and the understanding, the history of who is managing your assets and what their history and experience is at working out those assets, even if the assets are performing. But in a downturn, try to be with managers that have experience in both up and down environments, in both environments with lots of liquidity and environments that lack liquidity. Make sure they have experienced those, because you can have good assets in a bad liquidity environment and have a bad outcome. So stick to your fundamentals and make sure there's room for variance, because we're all not right every time.
Absolutely. And when we look at the private debt world, there's many different strategies, and we tend to focus on those groups that have strong collateral and that have groups that have underwritten to the worst case scenario of taking over that collateral and being able to either fire sale it in a time where there's not a lot of liquidity, or operate those assets, whether in the real estate space. For example, Rob, have you had to take over many assets in this environment?
Yeah, we've got, so in this environment, I don't know that COVID particularly, got them off sides or whatever, but we've worked through this year. We've worked through about a dozen, just about a dozen. And I would agree that you want to look for multiple off ramps. So some of them we've taken through the foreclosure process. Some of them we've sold to other people. Some of them we've sold to NPL buyers. Some of them we've sold to other guys who are going to fix and flip it and finish it off.
Okay, great. And I do want to we're getting to a lot of the questions offline here and answering them directly. But one thing that keeps coming up is New York, for example. And one of the questions is, how are you analyzing litigation finance in a place like New York, where there's not only a moratorium, but there may be political pressure going forward? And I want to kind of expand that a little bit further in the last few minutes to say, geographically, the same thing's happening in real estate. There's concerns about New York. How are you looking at things from a geographical perspective? Where do you lend, where do you not lend, and where do you see risk and not risk? So either Jeff, any one of the panelists can answer that question.
What was, I'm sorry, what was the question? You came in and out. I apologize.
No worries. It has to do with New York, for example. There's a lot of people seeing more risk, either from a real estate standpoint, litigation finance standpoint. Are you concerned of any areas within the U.S. Where you lend to, or where you're just kind of sitting back and being more patient to see how things play out from either a political standpoint or any concerns that you have geographically of lending within the U.S.?
Well, I think it's both. It's such a unprecedented time right now that you have federal and state regulatory things to think about. In the mortgage market, you have forbearance issues. You have rent moratorium and eviction moratoriums. In the consumer market, you had, bankruptcy. In consumers in bankruptcy were given 90-day holidays. So I think, and depending on each state, different states had limitations on how people were treated on an employment basis in certain businesses. So I think, which are directly correlated to the infrastructure and collecting across a number of these asset classes, especially finance. So I think one has to be cognizant of it. I do think, the political environment, if it changes, the powers that be, I think, we have to have a functioning economy, and you just hope the powers that be recognize that for creditors to provide liquidity, borrowers have to pay back their loans. And we all want to be compassionate and empathetic to something that's been brought on that's nobody's fault. But it's going to be an interesting environment going forward, just to, I think, short term and intermediately. I think, I still believe in, our structure and our way of life here and the way we look at capitalism. But I think, very realistically, we all have to be cognizant of this is, sort of unprecedented times. And when you make an investment or you make a loan, give yourself a little bit more room for error, so that, no one can guess, no one has a crystal ball, but just be mindful of these different things that are going to come up that you don't know, and the ones that are there, and just be mindful. It's just a mindset of risk management.
Absolutely. And in the last 30 seconds, Dimitri, maybe you can say where you're interested in lending within the private credit world and where not. And sorry, Michael, I know it's 1:30, but want to give Dimitri one last.
Absolutely.
Yeah, we can stop. I mean, again, our exclusive focus is on lending against collateral of private funds. So that's kind of a broad statement. So anyone who is looking to borrow and increase leverage, or for any other reason, basically submits their fund to us. We do due diligence, and at the end of the day, if that collateral is approved, they get themselves a loan.
Perfect. Well, thanks everyone. Michael, I know it's 1:30, so we appreciate everybody's time, and feel free to contact any of the panelists here to ask additional information. And congratulations again to Flya for putting this together in a challenging year.
Mark, thank you very much. Thank you to all the panelists. Thank you, Rob, Jeffrey, and Dimitri. Great job today, and the best of luck to you and your firms